Hello guys, good evening everyone. Nice to have you guys on the call. Please mute yourself. If you know you're not mute yourself. Hope you guys are doing great. Firstly, I must apologize about yesterday's. We were supposed to meet yesterday, and unfortunately we could not because I stepped out to go get some stuffs, and I was stuck in serious hold up, like in a traffic, and I was dirty. It was past 6:30 and the rest of it, and I was still trying to see how I can get home quickly so I can take this class, but unfortunately it was more than what I expected. So sorry for that, guys. And that's exactly the reason why we are holding another class today, and we are going to talk about the topic we were supposed to cover yesterday. That's the topic we'll be covering today. Hope you guys remember what we talked about in our last class. And I also dropped the video on YouTube, sent the link for you guys to go and watch, I think from day one, which was the introduction to the day 6. Everything was recorded and is on YouTube. So let's go straight to the point today, guys. What we'll be talking about today is going to be how to use imbalances and order block. You guys can see my screen now, right? You can see what I have on my screen, right?
Yes.
All right, very good. Very good. What I have on my screen right here, it says other blocks, and it's also talking about market inefficiency, which is imbalance, right? So I'm going to teach you guys today why imbalances are being created and how imbalances how we use imbalances for our entries and also for our exits, because there always have to be an imbalance where we smart money traders are always looking to enter a trade or to exit a trade. It's important. Now we also use liquidity for exit points and for entry points, but we also use imbalance, which is much more important. So now let's first of all talk about the order block, right? Did we talk about other blocks in our last class? For those of you that attended, we did not talk about other blocks, right? So one of the most important concepts within this strategy is the understanding of order blocks. You have to understand order blocks, because order blocks are areas where we look to take our entries. You understand? Order blocks simply tells us where the smart money themselves entered the market, where they bought or where they sold. That's why it's called an order blocks, because there are multiple orders that has been placed at that particular level. And when the market gets to that particular level and triggers or mitigates that order block, then the market will now move to the opposite direction after the mitigation. If it mitigates a order block that is a supply, it pushes to the downside. If it mitigates an order block that is within the demand, it pushes to the upside. You understand? So now, an order block is an area on the chart where we can clearly identify a large order being placed in the market. First of all, you will notice the order placed and then followed by a rapid movement away from the area, which leads to a break of structure. Now, that movement, what I said here is you will notice the order placed. The order block is the reason why you will know that an order has been placed. Without an order block, you won't know that an order has been placed. So you have to use the order block as a clue to what you need to see, and I'm going to give you guys several examples of other blocks and how I trade with other blocks, right? And you will notice the order being placed and then a rapid move away from the area. That rapid move away from that other block is what causes what we call imbalances or inefficiencies or fair value gap. If you talk about inefficiency, if you talk about market inefficiency, if you talk about imbalance, if you talk about fair value gap, they all mean the same thing. They all mean that rapid movement away from the other block, away from the supply or the demand. That rapid movement, that impulsive movement is what we consider to be it's what creates inefficiency. That's what creates imbalance. And the reason why we always have this impulsive movement or this rapid movement, can you guys hear me? Hello?
Yes.
You guys can hear me? All right, let's continue. Let's ride on, guys. Now, what causes that impulsive movement is the amount of people, the amount of money that is entering the market at that point. You understand? The amount of people that are entering the market at that point. Because these guys are smart money traders and they are entering with a huge amount of money. Like I told you guys, they trade with trillions. They are the banks. They are the institutions. These are the big institutions in the world. So they have trillions of dollars. The smart money traders are the ones that move the market in their own direction. You understand? So they have the liquidity, they have the funds, they have the market to move price in any direction at any time. So it is because of their entries that they are entering at that other block that causes that rapid movement that now creates imbalance in the market. You understand? Now, this is how we identify order block. These impulsive movements away from that level, it will always give us a break of structure. Without a break of structure, we don't consider that impulsive movement or that rapid movement to be a consistent movement. But if it leads to a break of structure, then that's the first confirmation that price is about to move in the direction that we think. I will give you guys example of these things, right? So now this is how we identify the order block. The candle before that rapid move is what we identify as the order block. These are essentially areas of supply and demand within the market. You understand? These, when we talk about order blocks are not different from your supply and your demand. Other blocks are simply the advanced supply and demand. You understand? So we are not looking for the entire supply or the entire demand. We are looking for an order block within the supply and the demand zone. You understand, guys? When we are looking for an order block, we are looking for an order block within the supply and or the demand zone within the market. Right? And these order blocks must always lead to a break of structure with that impulsive move that creates imbalance. So now, let's move on and talk about market inefficiencies, or we call it imbalance, right? Price imbalance from when price makes a sharp price imbalance forms, sorry about this guy, it was supposed to be form, not from. Price imbalance forms when price makes a sharp movement one way or the other. That sharp movement is an impulsive movement. That impulsive movement happens when the smart money traders are taking their buy or sells from the other blocks, right? That's when you see that sharp market movement. You get, let's say for example, if something heavy hits your door, it will break it down. But if you just throw a little stone at your door, it won't be able to break it down. Am I communicating? But if something very heavy hit your door, it will break in. So when a huge amount of money enters the market, it causes a sharp market movement. You understand? It causes a sharp market movement that then move market away from that entry level. You understand? So the open space then forms a price imbalance that is more often than not filled by a future price movement. So that movement, that open space between the candles in the market, that's what forms market imbalance. That space then forms a price imbalance that is more often than not filled by a future price movement. So we use price imbalances to identify targets for our trades and to filter entries. We use imbalances listing to identify targets. Targets are levels we want to enter. Every demand you want to pick should have imbalance and should break structure to the upside, and every supply you want to pick should have imbalance and should break structure to the downside. That's how we use imbalance to identify our targets. No imbalance, there is high probability that price will not return there. But with imbalance, there is high probability that price will do what? Return there. So we use it to filter our trades and to filter our entries. Now, imbalances are best used to identify potential areas of interest for targets and entries, and should always be used alongside other market flow aspects. Now, we don't just use only imbalances for entries or for targets. We use them with other market flow aspects. Now, we use imbalances with market structure. We use imbalances with supply and demand. That's how we use imbalances. You don't just use imbalances. I will show you guys now, right? So the best used in conjunction, market imbalances are best used in conjunction with key levels, supply and demand zones. Fair value gaps, which is FVG or imbalance, all of these terms refer to the same idea, although traders use different words to describe it. Yeah, some traders from the ICT will say FVG, some traders from smart money will say imbalance, some traders from somewhere will say market inefficiency. But you have to understand that they all mean the same thing, depend on who is teaching you. I use imbalances. It's as simple as that. Fair value gap, that's something too long for me. I just use imbalances, right? That's good. So different traders, different thing. So market inefficiency occurs when the wicks are separated by distance or gap and they don't meet. So this is the example up here. This is the example 1 up here. I want to put it in a way you guys can see. All right. Now, let's do it this way. Let's do it now, like this. You see what we have here, right? Hello, guys. Are you guys there? Hello?
Yes.
All right. Yeah. If you're there, always answer me, please. You see this open gap here and here. There is an imbalance right here, right? There is an imbalance right there. The market will always trade to come and fill the imbalance and mitigate the demand. Now, you see what the market did? The market pulled down, pulled back up. At this very level, that was when we see an impulsive shift to the downside, and then it led to a break of this structure point, right? Which means market structure is bearish. Look at market structure. We have a high, we have a low, we have a lower high, then we have a lower low. Now, if you look to the downside, you see that from here all the way to this line that I drew, it also have what? Imbalance, right? Which price needs to come and
build up.
Good. You guys have to follow me. Now, if you look from this high all the way all the way to this level here, what will you see? You will see that there is also what? An open imbalance here. Are you guys seeing it?
Yes.
Right? So now that we have seen the market push down from here, I'm expecting the market to go up and do what? And fill those imbalance. On its way to fill that imbalance, it will then mitigate this supply zone that broke structure. From there, it should sell until it covers this other imbalance. So now I'm using imbalance here for my entry target, and I'm using this imbalance here for my exit target. I'm also using it in conjunction with what? Market structure and liquidity. Now we'll talk about liquidity. Let me not talk about that right now. This is in another class. But with what you guys can see, right? You can see the picture very clear. Let me remove some of these things and show you how imbalances are being used, right? Now, imbalances are caused by impulsive movements. You're getting it, my guys? Now, if you look at this impulsive move to the upside, it created what? Open imbalance. Are you guys there?
Yes.
And then this impulsive move to the upside also broke structure just like this one, and it also created open imbalance, right? And then it impulsed again to the upside and also created an open imbalance, and then it also created impulses to the upside and also left what? Open imbalance. Now because the price is overbought, if you look from this low to this high, if you look at the trend of the market, that's why I say the first thing you look at is the trend of the market to know where the market is positioned, right? Look at this low. This is low, and this level up here is high, right? So what should you expect? You should expect some sales because it is overbought. Especially it has mitigated this supply. This is a supply up here. You can see the pink. That's a supply. And if you look to the downside, there is an imbalance that needs to be filled. Now, the market algorithm has programmed these imbalances to always be filled, if not now, but later. So it can provide a fair value for both buyers and sellers. So now I have seen the market trend that the market is overbought, which is about to sell. Look, when price was going up, we were seeing weak momentum. Let me remove all these things. Right? So you can get it with me. When the market was going up, right? When the market was going up, you see this push to the upside was weak, right? This push to the downside, sorry guys, this was more like a pullback. See, the impulse to the upside was strong, the pullback was weak. The impulse was strong, the pullback was, are you guys seeing? The impulse was strong, the pullback was weak. The impulse now is strong, is weak. Look at the movement to the upside is weak. In the market structure class, what did I tell you guys? I told you guys that once it gets to a structure high and the momentum now starts to die out, you should know that the sellers are now taking over. All the movement to the upside was impulse, but looking to this level, the momentum died out. Immediately the momentum died out, the momentum to the downside kicked in. The momentum to the upside again died out, the momentum to the downside kicked in. The momentum to the upside died out, the momentum to the downside kicked in. Are you guys seeing?
Yes.
Now there is no reason for us to still look after buy, but people that don't understand, they will still be looking for buy. The market has given us a change of character here. If you can't see a change of character here, it has also given us a change of character here. And after a change of character, you wait for a pullback and then you sell from that supply zone that broke structure to the downside. Do you guys understand?
Yes, boss.
I'm trying to explain to your perfect understanding, guys. So now if you look at the trade, this is the trade, this is the after of the trade, this was the before, right? And this is the after of the trade. The market pulled back to fill the imbalance. Immediately the imbalance was filled, it started to sold off to go and target this other imbalance. Let's go into the Discord so that you see the trade. I called out the trade for the entire team, right? And we took that trade, we all took the trade together. It was a NAS 100 trade. It was a NAS 100 trade. I think it has gone really far, but I'll try my best to get to it. You understand, guys? So just give me some time, let me just be looking for it. Once I can get it.
Can I ask a question now that we until after you are done?
Just wait, let me just show this trade example and then you can ask the question. But that's basically how I take my entries, but I really want to show you guys that trade on NAS. The very trade I used there as an example. That trade is more like cannot trade. Alright, you can ask your question while we are looking for it, as far as it will not take us from this place, as far as it will not take us to another place.
Okay.
Yes.
The zone where you have your POI that you sold down.
Yes.
I feel that I can see an imbalance above the zone, and I want to know why your POI was not placed above that zone. So there's an imbalance there, but rather
Now
you use the second zone for yourself.
Now this is what we call a breaker block, right? This is a breaker block. The price have already reacted from that breaker block here. You understand? So this was the one that is much more important. This push to the downside did not break structure, it took liquidity. This push to the downside broke structure with a full body candle. This one was with a wick. That's liquidity grab. It can easily take this liquidity and go and take out this high. You understand? But until it broke that structure with a body candle, that was when I realized that price is going down. Now I use the concept of higher highs and higher lows. So for that reason, I do something like this. This has given me a high, this has given me a low, this has given me a high, this has given me a low. Now I am not going to get a higher, we are not going to get that kind of higher. No, this is the high here. So the next thing I'm expecting is going to be a lower than this guy, which can be around here, since this other high is here, so that it can give me a new lower low around here. Do you get now? Do you get now? All right, so that is it. Let's go back to the Discord. I'm still looking for that guy. But if you guys go and study my chart, like this place, the mentors chart, if you go to the mentors chart, to study my charts, I always drop before and after. Now if you look at this trade example, you see open imbalance, you see that we have a break of structure, you see that the market structure is giving us a lower highs and lower lows. So this move is expected to mitigate this supply that broke structure and sell off. That was my intention, right? That is exactly why you see that trade there, right? If you look at this entry as well, you see that there is an imbalance down here, and this is the last demand zone that brought in this impulsive move to the upside. So our expectation is that price should come in. You see what price did there? The market came straight into that level to fill the imbalance and then shoot to the upside. You understand? So that's how I use imbalance for trading. Are you guys still there?
Yes.
All right. So the this thing I will give you guys right now, the assignment I'll give you guys right now is to go to my chart, right? Go to my chart, my the mentors chart. Go there and learn from my past previous setups like this. Try to look at how did I try to look for this entry. Like, this is a market structure, right? Looking at the market structure, I taught you guys about supply. This is a supply. I taught you guys about break of structure. This is a break of structure. I taught you guys about change of character, right? I taught you guys that price needs to return here. Go and look at my chart, my before and after. Why am I looking to enter from some certain areas where I am entering from? You understand? It's very, very important. Try to know the reason why I took some of the kind of trades that I'm taking. You get it? So let's say, for example, let me just jump onto the chart right now. Let me jump onto the chart. All right. Let's say, for example, guys, let's say, for example, we have a movement like this, a pullback, and then an impulsive move to the upside. Once it breaks this structure high, we are going to look for an area of imbalance. So if we know that this is an order block, another block is the last candle that leads to a break of structure that also have an open imbalance. Now we expect price to come down and do what? In the case of filling up this open imbalance, it will then mitigate this demand and then push to the upside. You understand? That's mainly how you use your order blocks. You understand? You want to make sure that your order blocks are in line with your supply and demand zone. You understand? So you have to go to my chart and see how I pick my own zones that I take my trades from. What are the things that makes me take those trades, right? Now if this trade can push down and break this structure low, I'll wait for the pullback and sell, right? But if it has not broken any structure low, it simply means the market will continue to the upside. So look at it. We pulled up, we pulled down, we did not break this low, therefore we pulled up to break this high. We pulled down, we did not break this low, therefore we pulled up to break this high. We pulled down, we did not break this low, therefore we pulled up and broke this high. We pulled down, did not break this low, therefore we pulled up and broke this high. We pulled down, we did not break this low, therefore we pulled up to break this high. Once we pull down and we are not able to break this low, don't enter from here. That's a trap. Price is going to take that high. For you to sell from here, price should break this low. Are you guys there with me? Hello?
Yes.
Price has to
Yes,
break
boss.
that low, right? Now if you look at what I have here, you'll see that this is the level that we saw this impulsive move that broke this structure high. Because of this imbalance, I'm expecting price to come down there. Now most importantly, price has given us a liquidity equal low and we have imbalance below it. So price should come down on the cost to fill the imbalance. It will then mitigate our demand zone and then a buy continuation. Now if you look at this trade as well, price impulse to the upside, giving us a change of character. After this change of character, there is an open imbalance, a place where price has not really come to. You look at the upside, there is an open imbalance. All of this open space are open imbalance, so price has to buy from here to go up and fill up those imbalance. So my entry is going to be here, and I'm using all of this area for my trade levels, for my targets at area to take profits, right? I can take profit 1 here, I can take profit 2 around here, but most especially I'm working with imbalance, and I'm also working with market structure. If you look at this trade, you will see that this impulse to the downside, it broke this low. So for round, we are in line with market structure, lower highs, lower lows, and lower highs, right? After this imbalance was created, price needs to impulse to the upside to go and fill the imbalance and continue the sales, right? And this is exactly what happened there. You see that price trades to go and fill the imbalance and then continue to sell off. So come into my own chart here that I call the mentors chart. Come here to learn. Look at, because of this imbalance, price come all the way from this high. Immediately it filled the imbalance, price started doing what? Buying. I have my before and after. Always come here to learn. You are getting it, guys? Hello?
Yes, boss.
Always
Yes, boss, you are
come,
here.
always come there to learn. Always come into my my stuff to learn. That place, my chart. Go and look at how I find my entries in the mentors chart. You understand? That's how it is. Any question? We have less than a minute. We have less than a minute. Anybody have any question? If you don't have any question, wait for the recorded video. The video has been recorded. I'm recording it, and it will be sent to the YouTube channel, and from there a link will be sent to you. Do you guys understand?
Yes.
All right, thank you very much, guys, and I'll see you guys again in our next class. Thank you, guys.
Thank